Hey guys, this is Mr. Roxy coming at you live from Palm Beach in Florida. It is August the 4th. It is Thursday. This video is not about Oxy. I am not ready yet. I'm still going through the filings from the last conference call, or released around about the time of the conference call, just before the 8 and the 10. Haven't finished reviewing yet. It was a good quarter. It doesn't look to be a great quarter. Not as good as I had anticipated, but pretty good anyway. But we'll leave that one for the next video. What I wanted to do now is take a few minutes and take a closer look at what is going on in the marketplace, because there is a lot of stuff going on. And I think we need to kind of get familiar with the macro environment that we're in and see what we can do from a risk mitigation point of view to understand how to bulletproof our investments in this choppy trading season that we're in right now. So a couple of articles that I pulled that I'm going to share with you. The first one, here are 3 big reasons why a 2022 recession would be like no other. That was yesterday morning. Now, it starts off this article, in addition to featuring the CEO of the United States of America, saying that no 2 recessions are alike. But the potential recession in 2022 is looking most unique compared to any we've ever seen before. Now, that sentence, effectively, from a wordsmithing point of view, is somewhat deceptive, because this is not a potential recession. This is a recession. So we are already in a recession, and 2 negative quarters of GDP is technically a recession, whether the administration would like you to believe that or not. Home building activity has plummeted, while consumer confidence is at its lowest point. Home building activity is measurable. Consumer confidence is based on polling or some kind of other survey method where we cannot have absolute confidence that they know exactly how consumers feel, but it is reasonable to say that most consumers right now do not feel very confident at all. The labor market is robust. Now, this is an interesting one, because in 2022, however, unemployment is still at a record low. That is highly questionable, because the official unemployment rate in June was 3.6%. Now, when I see something like that, I'm wondering to myself, is that a typo? And they actually meant 36%, the lowest that it's been since February of 2020. Now, I'm not too sure about you guys, because I don't know where you all live and what you observe around you in the marketplace where you are. But I can tell you with absolute confidence, albeit anecdotal, that the official unemployment rate where I am is nowhere near 3.6%. Maybe it's 10, maybe it's 15. It's high. There are a lot of people who are willing to work who cannot find jobs, despite the fact that they keep telling you that there are not enough people available to fill the number of jobs out there. So I don't know what you guys think about the unemployment rate, especially in the US, of 3.6%, but maybe you can tell me what it's like where you are. Companies are cash rich. That's one of the other reasons why the recession is not like any other. The average US corporation's after-tax profit is around 16% right now. It's pretty good. In traditional recessions, this rate drops down to single digits. Meanwhile, these corporations are collectively sitting on over $4 trillion in cash. I have no idea how they can make a statement like that, because there is absolutely no way that they could possibly know how much cash the corporations are sitting on. And what I mean by that is simply that many of the corporations that we can track and report on are publicly traded. So you kind of know what cash and cash equivalents they have based on their last quarter's balance sheet. However, many very large corporations are privately held, and you have no idea how much cash they have, because they don't need to tell you. But anyway, we do know, sort of, just even if it is anecdotally, that corporations are sitting on a record level of cash. People generally tend to stockpile cash when times are uncertain, or if they feel they're heading into a recessionary environment. I do the same. Maybe you can do the same too, but more about that later. What comes next? This is unsustainable, says the Wall Street Journal's John Hilsenrath. Either the economy recovers swiftly, ending the recession, or the economy keeps dipping, compelling employers to cut jobs. I think it's more of the aforesaid than the latter, because unlike the pandemic of 2022, which arrived with a bang in March, April 2020, and then 2 months later, we were back at the stock market levels we were before the recession, or before that little quick crash. That is not what's going to happen this time. It is more likely that the economy keeps dipping, compelling employers to cut jobs, which would not be a good thing and will certainly impact that 3.6% official figure on unemployment. This could be an ideal time to bet on beaten down growth in tech stocks if we have a soft landing. I wouldn't want to go anywhere near tech stocks. Growth stocks are hard to find, but they are there. They are out there if you look for them. However, in a hard landing, investors may need to take refuge in asset-backed defensive stocks like healthcare companies. No. Healthcare is right now is just a huge scam. So I don't want to go anywhere near healthcare companies. So that's two out of the way immediately: tech stocks and healthcare. And real estate investment trust. Real estate investment trust could actually be a really good potential investment for you, especially if it's a high dividend paying REIT, R-E-I-T, real estate investment trust. Most or many of them are, but you want to make sure that your real estate investment trust is not invested in asset-backed commercial paper, and specifically as it relates to commercial property or something of that nature. In that case, stay away, shy away, and find yourself another REIT. More about that one in just a second when we talk about Uncle Warren. In the meanwhile, GOP, this is the Grand Old Party, Senator Mitt Romney. Now, that implies that Mitt Romney is a Republican. I'm not sure if everybody would agree that Mitt Romney is a Republican. Most Democrats would probably also agree that Mitt Romney is not a Democrat either. I think Mitt Romney is one of those politicians who leans any way the wind blows. Anyway, Mr. Romney says a billionaire tax will trigger heavy demand for these two physical assets. Get in now before the super rich swarm. Well, what are they, Mr. Romney? Let's quickly take a look here at what Moneywise says. Firstly, after all, Romney made much of his fortune through private equity firm Bain Capital, whose funds own shares in companies like Amazon and Alphabet. But he didn't mention tech stocks, and rightfully so, because he shouldn't, because right now tech is not necessarily where you want to be. If you know something about tech that I don't know, then please share with us in the comment section below, because we can all learn from you. But instead, Mr. Romney talked about how our chief executive officer Biden's proposed tax on billionaires to help pay for trillions in spending would boost demand for two specific asset classes, farms and fine art. Those two things are very, very, very different. Let's take a quick, deeper dive, and then we'll go to Warren Buffett. Between 1992 and 2020, that's a 30-year period, farmland returned an average of 11% per year. That is pretty good, because you can double the size of your portfolio value every 7 to 8 years if you can compound 11% per year. Over the same time period, the S&P 500 returned only 8%, which means you'd have to wait at least 10 years to double your portfolio value if you were invested in an S&P 500 index fund, for example. How about artwork? Well, it provides the one thing that matters most to investors: market-thumping returns. No, it does not. If you want to invest in art, you need to know what you're buying, you need to know who you can sell it for, and how much someone else might be prepared to pay you for them. Anyway, let's skip to the next one, which is Warren Buffett. What is Mr. Buffett doing? He said Bitcoin isn't going to do anything. He'd rather own these two tangible assets instead. I'm going to skip the Bitcoin bit because I don't really want to go there, but let's take a look at what Moneywise says. Farmland. Once again, farmland. Warren Buffett's point is, if you buy farmland, you hold a tangible asset that produces food. I'm going to tell you about one of my assets that produces not only a return on investment, but also some other things that might be of interest to you in just a minute. Moneywise also says publicly traded real estate trusts. Again, real estate investment trust REITs that specialize in owning farms allow you to do it with as little money as you're willing to spend. It's not spending, it's an investment. So those are the wrong words. But what you can do, which is really good advice here, is firstly, you look for a REIT that you would like to invest in, preferably one that pays a big dividend. And then in addition to that, you look for one that is specializing in owning farms rather than owning asset-backed commercial paper like strip malls and plazas and hotels and things like that. Don't go there. find a REIT perhaps that specializes in owning farms like Mr. Buffett. And then maybe you can make some money over time anyway. And in addition to that, you can earn a nice dividend while you wait. How about apartments? Well, there are not too many millionaires and billionaires who are probably listening to this channel. So it's unlikely we can buy apartments, but you don't have to, because you can always buy an apartment building yourself, find tenants and collect the monthly rent. But if you cannot do that, you can get an apartment focused REIT to do that for you. So here are two great suggestions as it relates to Warren Buffett, because he's actually sharing with you, the writer, that instead of buying farmland and apartment buildings, rental income as it were, you can buy REITs that invest respectively in farmland or otherwise apartments and make some money that way. I'm going to skip the rest of the article here. And then we go to this, just in, the India Business Standard. So this is from India, and this is today, August the 4th, 2022, updated at 16:33 IST. That would be 4:30 in the afternoon, India Standard Time. We're looking at Brent. Crude futures rose 10 cents, or 0.1%, while West Texas Intermediate crude futures was up 21 cents, which is 0.2%, at $90.87. Now, today we actually dipped below $90 per barrel on WTI, so there's no question that there's downward pressure on Brent and WTI right now. Both these benchmarks fell to their weakest level since February in the previous session, after US data showed crude and gasoline stockpiles unexpectedly surged last week. Really? It unexpectedly surged? How? Why? Where did that come from? But more importantly, OPEC Plus agreed to raise its oil output target by 100,000 barrels per day. Are you an Oxy investor? You will probably know that Oxy generates and produces approximately 1.2 to 1.4 million barrels per day. And OPEC Plus is all the OPEC countries together saying that they're going to increase their oil output target by 100,000 barrels per day. This is actually literally nothing. It's not compelling or meaningful at all, because it equals only about 0.1%. It's actually slightly less than 0.1% of global oil demand. So this is actually not even news. OPEC Plus agreed to increase production by 100,000 barrels per day in September, far lower than the previous month's production. The global energy market still faces supply shortages, says Leon Lee, an analyst at CMC Markets. Is that right, Mr. Lee? The global energy market still faces supply shortages? He said WTI prices are likely to oscillate between $90 and $100 per barrel. Tend to agree with that. While the United States has asked the group to boost output, spare capacity is limited, and Saudi Arabia may be reluctant to beef up production at the expense of Russia. Well, of course, because the OPEC group is in the business of making money. They're not in the business of doing anything to appease the United States or its chief executive officer. Ahead of the meeting, OPEC Plus had trimmed its forecast for the oil market surplus this year by 200,000 barrels per day to 800,000 barrels per day. 3 delegates told Reuters. Once upon a time, Reuters was a reliable source of news. It looks like OPEC Plus is resisting calls to boost output because the crude demand outlook continues to get slashed. That makes sense. The world is battling the ongoing global energy crisis, and it won't be getting any help from OPEC, said Edward Moya, a senior analyst with Oanda, in a note. Now, here's where it gets really interesting thanks to India Business Standard. Oil demand outlook remains clouded. In other words, we don't quite really know, but there are clouds on the horizon because of rising fears of an economic slump in the United States and Europe. Not the rest of the world, but these are 2 large economic blocks. Debt distress in emerging market economies. That makes sense. And a strict zero COVID-19 policy in China, the world's largest oil importer. I'm not sure if there's a strict zero COVID-19 policy in China, like as in overall the entire country, because most of the news, even though most of the news we receive is fake news, tells us that it's centered in the major cities, especially like Shanghai or Beijing. US crude inventories rose unexpectedly last week Why would inventories rise unexpectedly? Shouldn't we know based on supply and demand and consumption on an ongoing basis what the level of supply is more or less? Are we that nearsighted that we don't have the ability to kind of see where the inventory is? As exports fell and refiners lowered runs, while gasoline stocks also posted a surprise build as demand slowed, said the chief executive officer's propaganda department, the Energy Information Administration. Supporting prices on Thursday, however, that was today, the Caspian Pipeline Consortium, CPC, which connects Kazakh oil with Russia's Black Sea port of Novorossiysk, said that supplies were significantly down without providing figures. So the CPC says supplies are significantly down, but in the US, we posted a surprise as demand slowed. You know, these two paragraphs kind of, one contradicts the other, except that they're in different geographies. So I kind of forgive them for the sleight of hand there because I can't quite make out what's going on there. But what are the things that you can do when you have this kind of a recessionary slump? I'm going to show you a couple of images in just a second. I have been trimming some of my positions, taking some profit. I've also, no, I haven't actually taken any losses. I've just taken a little bit of profit, which means I'm also going to have a tax liability depending on what happens for the rest of the year. But my cash position in my account currently is about 20% thereabout. So I have multiple trading accounts and they're all sort of sitting on a cash position of 20% or greater. The reason why I do that is twofold. Firstly, it allows me to have some dry powder in case I want to buy something, right? So if something really crashes and tanks, so let's say Oxy goes to $45 per share, maybe I want to pick up some more, and then I have some cash available in order to, dip my toes in the water when the price really, really tanks. The other thing that cash does for you, despite the fact that holding fiat currency is completely unattractive because of the declining value of money, is the cash actually creates a hedge. So in times of uncertainty, at least you got that going for you when you have a bit of cash, because when the market is pulling back and your stocks are declining, your cash position is basically just sitting there, cash awaiting investment, right? So that's one thing that you can do. The other thing that you can do, which I've shared with you guys many times before, is you can certainly hold a basket of juicy, high dividend paying stocks. And these would include things like I've mentioned before in previous videos, like ICANN that pays 15%, or AllianceBernstein or Energy Transfer that pays 8%. This is the annual yield. Energy companies like Enbridge Energy and Pembina Pipelines that pays about 6.5% on an annual yield basis. I have many positions, including financial stocks. Some of the financial stocks pay 4.5%, 5%, like Scotiabank, TD Bank, etc. So I have a basket of stocks that actually provides me with a bit of a hedge because the dividend is quite high, right? In addition to the fact that if I can average out my dividends at around 6, 7, 8% even, that's like half of what I try to achieve in terms of achieving a 15% annual return that I can compound. But let's show you a couple of other things that I invest in. And I just want to share a couple of images with you, and maybe one website image. This picture over here is actually an internal shot of our family's charitable foundation's gift shop. Now, you can see a couple of different products in here. Firstly, what you have is an art collection. There's an art collection that you can see hanging on the top of the walls here. This is actually the first 39 presidents of the United States. They're all framed in the same manner. They're oil on canvas paintings. And the first 39 presidents are Washington to Carter, and they were done by a US artist by the name of Lawrence Williams. So that would be an alternative investment. I do not recommend art as an alternative investment because it's a very, very difficult game to get into unless you know what you're buying and you know the buyers and the sellers. But there are other things that I invest in as well. So you can see different types of products here. So there's lots of leather products that you can see. There's other art pieces on the wall. There are musical instruments in the back. Each of these are one-of-a-kind products that effectively, when times are down, I can stockpile these inventory items and then sell them at a later date. And depending on for how long I keep them, the price effectively will rise over time in theory, because my input cost, once the product has been manufactured, effectively is static, right? So if I make a product and it costs me $10 or $100, that's a fixed cost. But perhaps if I keep it for a year or 2 or 3 or 5, depending on what my ability is to hold on to that inventory, in the future, I could potentially sell it for a much higher price, thereby increasing my gain over time. But the other thing that we invest in as a company, like in terms of what you're looking at here, are jobs, because effectively what I'm doing is I'm giving an opportunity to artisans, for artisans to manufacture products for me. And when those artisans make products for us, they are effectively getting employed. And this gives me an opportunity to invest in people. So it's not just the actual commodity or the goods that I'm investing in, but I'm also investing in people. I'll give you a practical example of that in just a second. So let me go to the shop here for our charitable foundation, which, by the way, is called Memory Trees. And I'm not promoting or selling anything here. I just want to share the story with you. Right at the top of the page, it says Memory Trees is making a lasting impact through innovative charitable programs. Help us to change the world by how you shop. Sales revenue from our handmade, one-of-a-kind, full-grain leather products fund our charitable programs and trade scholarships. Our artists earn great wages for their work, which allows them to provide for themselves and their families. So I can invest in people, because when I invest in people, I actually create jobs for those people. Those people in turn create products for us, which we pay them for, and we pay for all the materials and supplies and anything that goes along with it. So anything in the supply chain, paying the artisan for the work that they do, paying for the materials and supplies, the shipping, the storage, anything like that, we pick up the tab for. But in lieu of that, what I have is a range of goods that I can sell on an ongoing basis, which funds our charitable foundation. But I can also wholesale these products to other shops who want to sell the products. And if I do so, obviously I can make a bit of money, which means I can earn an income and a return on investment from the products that we sell. So that gives you an idea of some of the leather goods. And then we have guitars, for instance. These are guitars, travel guitars, ukuleles, and things like that. Each one is handmade. Each one is unique. The artisans get paid for their time. We provide the materials and supplies. We pay, as I said, for the storage, the shipping, etc. And then we have all these products available that we can sell on an ongoing basis going forward and keep these people employed. So if the question is, what do you invest in when times are tough? The answer is, firstly, from an equities point of view, I hold a little bit more cash as a hedge. I invest in high dividend paying stocks. I might trim some of my equity positions, which is how I get to hold more cash in the first place. And then in addition to that, I start investing in people. So earlier on, when I talked about that unemployment rate of 3.6%, we see it much higher than that. But if I can give people skills, I'm investing in them. And in return, they learn to make products, and they start making products for us, which we can, as I said, stockpile from an inventory point of view when times are tough, and then sell over time, much the same way I would hold any investment for 3 to 5 years. I can also hold inventory for 3 to 5 years and then sell it over time. So those are some of the things that I do. So as opposed to buying farmland like Mr. Romney and Mr. Buffett, I can't afford to buy farms or lots of farmland. I can probably afford to buy a farm, thanks to Oxy. But instead of buying farmland, you can invest in a REIT. REITs are high dividend paying equities, and it can be a REIT that invests in farmland. I'm not sure you want to go anywhere near fine art, because that's a really tough environment for you as an investor. You can certainly own some high dividend paying stocks and increase your cash position a little bit until things get better. So what I'm going to do on the next video is close off on that Oxy filing. I'm going through the 8 and 10 filings from the Oxy website right now, and just looking through it to see what I can pick up on. Maybe the filings are not going to explain why Oxy has pulled back 12% over the past 2 days. That's more just a symptom of the energy market pulling back. But, as usual, wait a day or a week and then see what happens. And then we go from there. Anyway, thanks for watching. I'll be back soon with more. And the next one will probably be the Oxy video. So I'll talk to you guys then. Bye-bye.